The average Australian home loan at the time of making this video is around $659,000. Now, if at an interest rate of 6%, you allow that mortgage to last its full 30 years, you are going to end up paying approximately $700,000 in interest to the bank. So $1.3 million is what it's going to cost you to pay this home loan back. And that's in after-tax money. So what we want to be doing is looking at how can I get rid of this mortgage as quickly as possible. Now, I regularly hear people say to me, well, Phil, I don't have any extra money to throw at my mortgage right now, which I totally understand. The cost of living has gone through the roof and many families are struggling to make ends meet. But here's the thing, you don't need to earn more money to pay your home loan off faster. There are some very simple strategies that will allow you to more effectively use the money you've already got to pay your home loan down faster. Sometimes hundreds of thousands of dollars faster. In fact, I'm going to show you exactly how to do this in today's video. So today, we're going to look at a very simple strategy that focuses on offset accounts. And we're going to look at how do we use those offset accounts to help us get ahead on our mortgage and help us pay this mortgage off years earlier and save ourselves at least $150,000. Now, just to give you a little bit of background, I've been a financial coach for over 35 years. 20 of those years I was a financial advisor, and in that time I have literally had dozens of clients who have paid their mortgages off inside 10 years, saving themselves hundreds of thousands of dollars, and using some of the strategies that I am going to share with you today. Okay, so let's have a look at this very simple offset account strategy that can literally save you hundreds of thousands of dollars in interest and years of your mortgage without needing to earn more money. So let's have a look at the agenda. Now, before I go through that, if there's some noise in the background, I apologize. We have an excavation team here at the moment who are filling in our swimming pool. So there's a whole bunch of noise going on outside. So I apologize for that. We will try to edit it out. Okay, the agenda. We're going to look at how mortgages actually work. Then we're going to look at what an offset account actually is and how it works. We're going to look at the ideal bank account structure to use with offset accounts. We're also going to look at the importance of having no lazy money slushing around, because lazy money tends to make us comfortable, which then means we spend more than we need to. We don't want that. We're going to look at the fees, because often people's objection to offset accounts is, well, what about the fees? So we're going to have a look at that. And then we're going to do a quick summary and recap. Okay, so let's have a look at how mortgages actually work. Now, I apologize if you've been through this before, if you know what this is, but there are many people that don't understand this, and I think this is an important foundation for the rest of the discussion. So let's just say we have a $600,000 mortgage, which is a bit below the average at the moment, over 30 years, so 360 months, at an interest rate of 6%. Now, that will mean that your average mortgage repayment every month is going to be $3,597. And scarily, as I mentioned earlier, at 6% interest, you're going to end up paying about $695,000 back to the bank in interest, which means that your total repayments over the years will come to almost $1.3 million. And that is in after-tax money, which means you have to earn about $2 million just to pay off a $600,000 loan after tax, which is very scary. So of course, we want to look at, well, how can I get rid of this mortgage earlier? How can I pay it down faster? Because the faster we pay it down, the less interest we end up paying back to the bank. Okay, so how is interest calculated? Well, very simple formula here. Balance owing on your mortgage times by the interest rate divided by 12, so it's 12 months in a year, will give you, that's the formula. If we look at $600,000 times 6% equals $36,000. If we divide that $36,000 by 12, we end up with $3,000 in interest that you have to pay on your first mortgage payment. Okay, so let's have a look at the amortization schedule. Now, this is where it gets a little bit scary because you can see here that your repayments are $3,597, but of that $3,597, $3,000 of it is interest and just $597 is principal. Now, the reason I tell you this is not to depress you, but because I regularly have couples who say to me, oh, Phil, well, yes, we've stretched ourselves a little bit with the loan, but, within 5 to 10 years, we'll have made the repayments and there'll start to be some really good equity in the home. And at that point, we can think about renovating or perhaps refinancing the home loan. But the reality is the first 5, 10, 15 years, you make hardly any dent in the principal. So your loan comes down by a very small amount over that time. The banks are getting all of the money in your home loans. And just let me show you this. It is not until month 223 that you find that the principal amount that you're paying for your home loan actually finally gets in front of the interest component being taken out. 223 months of 360, so almost 20 years in, and finally the principal amount is bigger than the interest component because the banks front load the interest to keep their profits. Okay, so let's now have a quick look at how offset accounts actually work. So let's just say I have a mortgage of $600,000 at 6% in year one. I'm going to pay approximately $36,000 in interest on that loan. It will be a little bit less than that, but let's just go with it, $36,000. And assume that I have an offset account, which is really just a fancy bank account that sits alongside your mortgage. If I have $20,000 in that, the bank's going to go, okay, you've got $20,000 in your offset account, so we are only going to charge you interest on $580,000. It's almost as if that $20,000 is off your mortgage. But be very clear, the offset account is a completely separate bank account from your mortgage. So $580,000 at 6% interest, I'm only going to pay $34,800 in interest on that loan that year. So that means I'm going to save myself $1,200. Now, because I'm saving that money, I'm not earning it, I don't pay any tax on it, it's just a clear $1,200 in savings. Okay, so let's take this a step further now. We've got the same $600,000 mortgage, but let's say instead of just having one offset account with our savings money in it, we went to a bank that said, okay, well, we're going to allow you as many offset accounts as you like, and so we add 2 more accounts. We've got an account that has all our bills money in it, and we've got an account that's got our discretionary spending money in it. In total, you can see we've got $37,000 between those 3 accounts. That then means that the bank is only going to charge you interest on $563,000 at 6% interest, which means that your total annual interest is $33,780, which means for you a savings of $2,220. Now, you might think, well, that's not a big deal. That's not a lot of money. But when we compound that over 30 years, you can see that by putting that money into offset accounts, it's like paying $37,000 off your mortgage from day one, which means that you're going to have your mortgage paid off 4 years and 5 months earlier, and you are going to save yourself $156,785 in interest. So simply by structuring your bank accounts differently. So I hope you can see the power of this. You haven't needed or been required to earn a dollar extra. You've just changed the way your mortgage and your accounts have been set up. So now let me take you through the flow of funds through those 3 bank accounts and how you set yourself up for success. So we've got 3 accounts. We've got our savings account, which has like our rainy day fund and our cash reserve in it. We've got our bills account, which is where all our bills money is. And then we've got our discretionary spending account. What we want to see is all of our income come into our offset account. So all forms of household income into that offset account. So in essence, we're saving first. Let's say we've got $10,000 coming in. What we then have is our bills account, and from our bills account, we're putting $7,500. We've identified that's how much we need in that account each month. Then from there, we pay for direct debits, or your bills get direct debited or transferred, or periodical payments, or this is where we pay off your credit cards or debit cards from. So this is our main working account, and we put $7,500 in there each month. Then we work out how much we need to put into our discretionary account. So let's say that's $2,000 a month. What that means is that $500 stays in your savings offset account. that is the default place that money stays if we're not using it. So what that means is we've transferred money to our bills account, we've transferred money to our discretionary spending account, and money should start to grow in this account. So let's look at the impact of this strategy now. We have the $37,000 that we've got sitting in our offset accounts, which is saving us interest. But on top of that, we have the extra $500 that is accumulating in your offset account, in your saving offset account. And over the course of the loan, you are going to be able to pay your home loan off 10 years and 6 months earlier. And more importantly, you are going to save yourself $303,000 in interest. $303,000 that you get to keep simply because of this strategy. Now, I hope this is sounding good to you because it really is this easy to pay your mortgage down faster and to save yourself hundreds of thousands of dollars. But there is one caveat, and that is we do not want any lazy money. And I'm more specifically talking about money building up in your savings offset account, but it does apply to your bills account and to your discretionary spending account as well. We do not want lazy money. And more specifically, this means that in your savings offset account, we really only want money for three purposes. And those three purposes are, firstly, we want to make sure that we've got enough money in there for a rainy day fund to cover you for those unexpected expenses. The dog getting sick, the car breaking down, the hot water system dying on you in the middle of winter. We want to make sure we've got that covered, and that should be sitting in your savings offset. We should also have money sitting in there for our cash reserve. So this is to protect you against big life events. And ideally, this is around 3 to 6 months worth of your household expenses. And then the last one is life goals that we're working towards. Maybe we're going overseas. Maybe we're buying a new car. Whatever those life goals are, that money should sit in an offset account. But anything over and above that, so figure out what the magic number is for you in that. And then anything over and above that should be taken out and either put into an invisible mortgage account that you don't have access to on a day-to-day basis and you can't see on a day-to-day basis, or permanently off your mortgage. We do not want any lazy money, because when we get lazy money, it tends to get spent. So stay focused, be purposeful with every single account. Okay, so let's have a look at the three really big benefits of using offset accounts. Number one is that your offset account will give you a higher rate of return than you can get on a high interest savings account. Number two is that an offset account will save you tax. And number three is that using an offset account will help you keep your home loan sacred, which is super important. So let's look at these in a little bit more detail. If on the left here we have a snapshot of what are the best high interest savings accounts at the moment from money.com website. So you can see we've got Rabobank at 5%, ING at 4.8, Macquarie at 4.6, and then Suncorp at 4.3. Over here, we have the best possible interest rates you can get on mortgages at the moment. 5.14, 4.64, 4.65, 4.74, and so on. You can see here that these interest rates that you are being charged in your mortgage are marginally higher than the interest that you can get on the best high interest savings accounts at the moment. So dollar for dollar, if I put $1 into a high interest savings account, I'm going to earn less interest on that than I'm going to save by paying $1 off with the best mortgages around. So let's have a look at the second benefit of using an offset account, and that is it will save you tax. And we all like saving tax. So if we look here, let's say I've got $20,000 and instead of putting in an offset account, I put it into a high interest savings account. Let's say I can get 5% interest on it. So I'm going to earn $1,000 in interest. But after tax, so your average tax rate around that 32.5%, including Medicare, means that I'm going to pay $325 in tax, and ultimately I'm going to end up with $674 that I get to keep. However, if I have this money instead in an offset account, $20,000 in an offset account at an interest rate of 5.14, slightly higher on the mortgage, that means I'm going to save about $1,020, $28 in interest. There's no tax on money saved, so I get to keep the whole $1,028. So you can see there's a very distinct benefit there of using an offset account. So let's look at the third really big benefit of having an offset account, and that is it helps you keep your home loan sacred. By that I mean you've got an offset account there that has all the benefits as if you had paid that money off the mortgage. In that account, you can keep your rainy day fund, you can keep your cash reserve, you can store money or accumulate money for your big life goals, and then anything over and above that, you can pay off your mortgage knowing that that is going to stay off your mortgage permanently. So we've got all the benefits as if we were paying off the mortgage, but it helps us stick to that golden rule that your home loan should only ever go one way, and that is down. So what we want to avoid is doing what so often happens when we open a packet of Tim Tams. It's a bit like touching our redraw facility once. Once we do it once, we do it again and again and again, and before we know it, the packet of Tim Tams is gone. We definitely don't want that for you. So having an offset account ensures that you can stick to this golden rule. So the last thing that I want to talk to you about is fees, because I often have people say, well, I like the idea of an offset account, but what about the fees that I have to pay, or do I have to pay a slightly higher interest rate? And this is what I say. Yes, sadly, most banks will try and charge you extra fees for the benefit of having an offset account. Remember, they're not a charity. They're in it to make a profit, and they will charge you money if they can. But here's what I would suggest is there's three things you can do. Firstly, you can negotiate and ask for a better deal. And you should be doing this every 18 months anyway. Going to your bank and saying, hey, XYZ bank down the road is offering 5.2% in interest. You guys, I'm currently on 5.5. Can you do better? More often than not, the answer is going to be yes. So make sure you're always trying to negotiate a better deal, and you should do that every 18 months. And you can also negotiate the fees. Then, obviously, choose another bank. There are banks out there that do not charge fees on having offset accounts. And then the last thing is, it is important that you understand the impact that the fees are actually having. So let me quickly take you through an example of this. So let's say you're charged an annual package fee of $295, which is the most common way that the banks will charge you fees for an offset account, through a package rate. And let's just say the interest rate on your mortgage is 6%. If we look at this, we go, okay, well, how much do I need to have in my offset account to make this work? And we can see in this example, if we've got $295 as the annual package fee, divide that by 6%, it tells us that we need a balance of around $5,000 sitting in our offset account before we start to get the benefit from having that offset account. So of course, you've got to think about what works best for you. Does this make sense to you? I would suggest that for most people, if you use the structure that I've shared with you, it will absolutely be worth your while using offset accounts. And let me remind you of why I think offset accounts are a great idea. Here is the example we used first up, where we had the 3 offset accounts with $37,000 sitting across those. You can see that we would save ourselves 4 years and 5 months on the mortgage and $156,000 in interest without needing to earn any extra money or pay anything extra off our mortgage. Simply having that money sitting in the offset account will save you $156,000. If we look at the second example that I shared with you, where, okay, let's say we accumulated $500 per month extra in that offset account, you can see here that that would save you 10 years and 6 months and $300,000 in interest. So these strategies are well worth adopting for your portfolio, because that $303,000 is an awful lot of money that you could save simply by having a basic strategy like this in place. Now, if this has been helpful so far, can I encourage you to click the like button, because that helps this content and my channel reach more everyday people. And please subscribe, because every week I release more videos with practical, no fluff money strategies to help you and your family thrive financially. Okay, so let's finish off with a very quick summary. The first thing that we need to remember is the banks get paid first. The first 5, 10, 15 years of your mortgage, the majority of your home loan repayments will be interest, not principal. So anything you can do to pay extra off your home loan in those first few years is going to save you a significant amount of interest over time and potentially years off your mortgage. Second thing is that offset accounts will help you pay down your mortgage faster without actually needing to earn more. Third thing is, think about the structure and flow of money into and through your world. So making sure that savings is the priority. All your income comes into your savings account. You pay yourself what you need into your bills account and what you need into your lifestyle account, and let all the extra money accumulate in your savings offset account. Simply just changing your thinking that savings comes first, then the spending can really help you get ahead financially. There are three really big benefits of offset accounts. Firstly, we will save more on an offset account than we can earn in a high interest savings account. Secondly, it's far more tax effective. And third, we're also going to be able to keep our home loan sacred, which is very important by using an offset account for our rainy day fund, our cash reserve, and for our big life goals. And the last thing is, make sure you understand the impact of fees. There are fees attached. Make sure you're negotiating with the banks. Don't let them get away with anything. Negotiate as hard as you can to have those fees or interest rates pulled down, and understand, well, how much do I need in my offset account for this actually to be worthwhile? So I genuinely hope that this has been helpful. Please don't underestimate these strategies. They are simple but super, super powerful. I have used them to help literally dozens of my clients pay off their home loans inside 10 years. They worked for them and they will work for you. Now, if you would like to learn more about how you can pay your home loan off faster, or perhaps you'd like to learn more about how you can take control of your money, or perhaps you'd like to learn how to get started investing, can I encourage you to check out the link below to my Money Boss Academy. Now, please remember, it is the little strategies, the little habits that you put in place today that can literally make $1 million difference to your future. Take care, and I look forward to seeing you in the next video.